Hello guys, a very good evening. Am I audible? Please give me confirmation. So we'll start today's lecture. Okay. Greeting to all this. Greeting to everyone. Welcome to Global Online. So today we are here to for the commerce and management, and here we are taking the unit number 2, that is auditing, accounting and auditing, and here we are going to discuss the most repetitive PYQs. Okay, because these are the PYQs which are really important and mostly repeated many times. Okay, and this is part 4th. So I just before go ahead, I just quickly tell you about the Global Online. Here you will get complete course of the commerce and management. If you register yourself for the paper 2, you will get 50% discount on the fees. So the 5,000 rupees, if you register yourself for the paper 2, paper 1 is free of cost for you. This is a big opportunity, and our new batch will be going to be started from the 29th of August. And what you will get over here, you will get daily live lectures, complete syllabus notes in PDF format. Okay, full syllabus, mock tests, more than 4,000 MCQ series with detailed explanation, PYQs with detailed explanation, and along with that, if you have any queries related to anything, so you can get in touch with this contact number, which is you can see in your screen. So how to download the Global Online? Just go to Google Play Store, download the Global Online, then register with your number, and after registration you have to go to my course and just register with whatever the course you want. Once you register, you will get you will find and you will see the interfaces look like over here like this. Okay, so the unit wise folder is given to you. So this folder, it's helpful to prepare very well for your examination. Okay, so let's start with the first question of today, that is read the following statements. Okay, and all the statement which is true. Okay, so the first statement is financial statements are only interim report. The second statement is financial statements are prepared on the basis of realizable value. The preparation of the financial statement is not an ultimate aim, and the certain assumptions are necessary to prepare the financial statement. So here is option is giving to you. Just tell me what will the right answer according to you. What do you mark? I know you prepared very well for your examination, and just polish your knowledge. Okay, over here just revise the things. Tell me. The question is the statement is giving to you financial statement are only interim report. Okay, then statement number 2, financial statement are prepared on the basis of realizable value. This is the question from the previous year question. Okay, this is the question, and here when we are talking, okay, look over here, when we are talking about the interim report or interim statement. So what is interim report or interim statement? Interim statement or interim report is a financial report cover a period that is less than 1 year. That is interim report. Okay, and this interim report are used to convey the performance of the company before the end of the end of the financial year. Okay, so this is your interim report. So the financial statements are only interim reports. It's for the less than 1 year. Isn't it true? Then the second one is in the financial statement prepared on the basis of realizable value. only the financial statement are prepared on the basis of realizable value. Isn't it true? Actually, one of the important rule in record all the transaction on the basis of historical cost. Okay, and here which is verified from the documents such as you can say your cash receipt, okay, for the money paid, that means the realizable value. Okay, then the preparation of the financial statement, actually this question is I have take from the previous year, and this question having the no specific solution. Okay, so this is a doubtful question, but I'm still taking this. The preparation of the financial statement is not an ultimate aim. Okay, when we are preparing the financial statement, preparation of financial statement is not ultimate aim. Yes, it is true, just preparing the financial statement is not ultimate aim of the particular company. Okay, they have a many aims to prepare the financial statement. Okay, there are certain assumptions are necessary to prepare the financial statement. Yes, there are the many assumptions is given in the accounting principle. So these are all the assumptions are important, are necessary while we preparing the financial statement. Okay, like a principle of the accrual basis. Okay, then principle of the conservatism. So these are the principles are important, these are the assumptions are important while we preparing the financial statement. So the option number 4 is true. Okay, then the option number 2 is true. So 4 and 2 is true, but we are not saying that option number 3 is true. So when we see over here, when we eliminate the option number 3, so these are all going to be cancelled over here. Okay, but we also eliminate the option number 1 is our only interim report. No. Okay, so this is one option is going to be cancelled. So that's why we see that there will be no option, no specific option which is true for this question. Okay, that's why this is a doubtful question. So the option number 2 is right over here, and option number 4 is right over here. Clear? Then the next one, which of the following is not a subsidiary book? Which is not a subsidiary book? Purchase book, sales books, bills receivable book, and the asset book is not. Okay, is not subsidiary book. Okay, try to answer me. I'm not getting your answer from your side. Okay, okay, fine. Without wasting my time, I'm just tell you that which is not a subsidiary book. Purchase book is subsidiary book. Okay, sales book is subsidiary book. Bills receivable is also subsidiary book, but asset book is not a subsidiary book. Okay, so the option number D is correct over here. Now the question is that what is a subsidiary book? Subsidiary books, that means the book that record the transaction which are similar. Okay, similar in nature. What? Similar in nature. Okay, in the ordinary manner, like a purchase book, they having a similar nature. Sales book having the sales record. Bills receivable having a bills receivable record. Okay, so these are the subsidiary book. Okay, then what are the different types of the subsidiary books? So we have seen the purchase book, sales book, and bills receivable. Along with that, we also have the cash book. We have the purchase return book. Purchase return book is also there. Sales return book. Okay, sales return, and the bills payable book, and the journal proper. Okay, this is the subsidiary book. Okay, then next question, which of the following are the application of the fund? Option number 1, redemption of preference share capital, payment of the dividend, increase in working capital. Which of the following is application of the fund? When you prepare the fund flow statement. Okay, fund flow statement. So this is your source side, and this is your application side. So the question is about this application side is what item in the application side according to given option. So the redemption of preference share capital, is it come in application side? Payment of the dividend is application side. Increase in working capital, isn't it application side? So tell me what is comes in the application side. Look over here, answer me. I'm waiting for your answer, but nobody answering me. Okay, fine. Look over here, that is what is application side. Application side is the side where we see the outflow of the fund, okay, and source size is for the inflow of the fund, okay. So that's why when what about the first thing which I have to tell you, that is increase in working capital. Working capital is means current asset minus current liability, okay. Increase in working capital, when your working capital is increasing, when your current asset is greater than your current liability. If your current asset is greater, that means your working capital is increasing, and if your working capital is increasing, that means either you have purchased some asset, either you have increased your debtors, okay, that's why your current asset is greater. Either you, that means if you are increasing your debtor, okay, that means your outflow of the fund, okay, your fund is going to be outflow from your company, okay. So when we are talking about the increase in working capital, so it's come on the application side, okay. So increase in working capital, it comes in application side just because of our debtors, we are assuming that our debtors are increasing, okay. Our debtor is increasing, that means we have pay advance loan or advance something to the outsider, and it will come after a duration of the time or after later, okay. So that means it is what, it is a type of which transaction, it is outflow of the fund, okay. So that's why it's come on the work, it's all comes the increasing working capital, it comes on the application side, okay. Then redemption of preference share, it also comes in the your preference share. Redemption of preference share, that means you redemption means they're completing their duration, okay. So the redemption of the preference share, that means you are paying to preference share capital, okay. So this is your outflow of the fund, so that's why it comes in the application side. And you know that this is a simple, the payment of the dividend is also you are paying something, that means outflow of the fund, so it comes on the application side. So option number D is correct, 1 2 3, okay. So the option number D is right. Then the next one, accounting concepts are based on certain assumptions, certain facts and figures, certain accounting records and government guidelines. So what will be the right answer? Accounting concepts are based on certain assumptions, certain facts and figures, certain accounting records and government guidelines. Yes, option number A is correct. That is certain assumption. Accounting concepts are based on certain assumption, because these are the assumptions are important, like a business entity concept, okay, like your going concern concept, money measurement concept, accounting period concept, you can say accrual concept, then your full disclosure concept, dual aspect concept, then materiality concept, revenue realization concept, okay. So these are all the assumption, historical cost concept. So these are all the assumption of the accounting concept, and accounting concept is based on the certain assumption, and these are the assumption. Now the main purpose of the cost accounting is to Option number A, assist the management in decision making. Then option number B, maximize the profit and minimize the losses. C, comply the norms issued by the government of India from time to time. And option number D, prepare the cost account in line with the accounting standard. So what will be the right answer? Main purpose of cost accounting. Why you prepare the cost accounting? What is the main purpose of the accounting, cost accounting? Assist the management decision making. We prepare the cost accounting to maximize the profit or minimize the losses, or comply the norm issued by the government of India time to time. Prepare the cost accounting line with the accounting standard. Okay, so this is not an option and this is not an option. Now the maximizing profit and minimize the losses, this is the aim of all accounting. The financial account, actually accounting is not for the minimize the losses or maximize the, yes, it is helpful for that, but the main purpose is not that. This of the particular cost accounting, it is also the main purpose, is also aim of the, or the purpose of the financial accounting is also purpose of the management accounting. Okay, so the option number A is correct. That means is assist, is help the management in the decision making. On the basis of when we prepare the cost accounting, it will help the management to take a decision about the cost of the product, about the overheads, about our interest we have paid, about the taxes to pay to the government. So these are the all the factors that is helpful to the management to take a decision with the help of the cost accounting. Okay, then the next one, transportation expenses incurred to bring a machine from the place of the purchase to the place of installation. So this is what kind of expenditure? Actually the question is talking about this is what kind of expenditure. That means this is the transaction expenses incurred to bring, that means when you pay some installation charges, when you purchase some machinery. Okay, so in that case, if you purchase some big machinery, so the installation charges is paid by the company. So that installation charges, okay, is what kind of expenditure? The transportation, the revenue expenditure, capital expenditure, deferred revenue expenditure, and the none of the above. So what will be the right answer? Okay, so here the question is talking about the machinery. When we are talking about the machinery, it is any company or anyone purchase a machinery for the long term. Okay, for the long term. So it purchase a machinery for the purchasing, not hiring. Okay, so hiring is a different thing. They hire the machinery. If they say the word hire, so in that case it is depend on the long term, either on the short term. So but here the word is used, that is purchase. Okay, so if anyone purchase a machinery is for the long term use. Okay, so when we are talking about the long term, so it will not be revenue expenditure, it is always a capital expenditure. And what about the deferred revenue expenditure? The expenditure which are incurred for the long term, but for the long term purpose, and for the to fulfill the specific, the things, that means the best example, that is advertisement expenses. So advertisement expenses is a kind of your deferred revenue expenditure. Okay, now the next one, the matching concept, matching items is given to you. List number 1, working capital ratio, then the cash equivalent, margin of safety, and ROI, then cash flow. The list number 2, cash flow statement, break even analysis, liquidity, and the solvency. So what will it, you know that is working capital ratio. Working capital ratio is, that means current asset divided by current liability. This is working capital ratio. Okay, so when we are talking about the working capital ratio, it show that company's liquidity. Okay, this show that companies, how liquidity company have, how much the current asset company have to solve their to pay the to pay his current liability. Okay, cash equivalent is for your cash flow statement. Okay, this is for your cash flow statement, and this is for your liquidity. Then margin of safety is basis on the break even point, so option number 2 is correct. And ROI, return on investment, this is the solvency period. Okay, so this is fourth one. No, this is not fourth one. This is not solvency, it is a responsibility center. It is for the responsibility, that is fifth one. Okay, so option number C is correct. Then the next one, bottom line growth refers to the growth in bottom line growth refers to the growth in sales, turnover, assets and profit. Okay, bottom line growth refers to the growth in your profit. Okay, option number D is correct, that is, it is your growth in your profit. Now let's understand the bottom line, top line, bottom line. So here, what is the bottom line? So bottom line is a company's net income, or you can say bottom figure of the company's income statement. Okay, and bottom line is the income statement pertain to the company in net income, and so this show your profit, bottom line. Now what about the top line? Okay, this also a word, that is top line. Top line refers to the company's revenue. You can say your company's gross sale. Okay, so this is your top line and this is a bottom line. Okay, so bottom line is show your company income statement, and income statement is ultimately is show the profit. Top line is for the revenue, and revenue is for the gross sale. Okay, they generate a revenue from on the basis of gross sale. Okay, before deduction of operating cost. Okay, next the question is in your screen, that is residual income. We have to calculate the residual income. So total asset is given to you, that is 12 lakh, sales is given 24 lakh, total expenses is 21 lakh 40,000, and normal rate of return 12%. So find out the residual income. How do we calculate the residual income? First thing, that is total asset is 12 lakh. Okay, yes, then the how do we, the total asset is 10 lakh, so from rate of return. So how do we calculate our rate of return? We calculate our rate of return on the basis of the total asset we have, that is 12 lakh. So the 12% of the 12 lakh is, it's 1,44,000, isn't it true? Okay, then the profit. So how do we calculate a profit? From sale, when we reduce our total expenses. What? Total expenses. So we will get our profit. Yes, so sale we have, that is 24 lakh, and the total expenses that we have 21 lakh 40,000. So how much profit company generate? That is 2 lakh 60,000. Isn't it true? Okay, so now we have to calculate the residual income. Okay, so how do we calculate residual income? Profit from the profit, when we deduct our rate of return, so we will get the residual income, that is profit is 2,60,000. From that we deduct 1,44,000. So answer is 1,16,000 rupees. It is your residual income. So option number C is correct over here. Clear? Now the next one, this is new profit sharing. In this question we have to calculate the new profit sharing ratio. Okay, so how do we calculate? The X, Y, Z are the three partners share the profit and losses in the ratio of 10:6:2. A was admitted for 1/10 of the share. Okay, uh, the new profit sharing will be, okay. So how do we calculate? First thing we have to see that is old ratio. Okay, so old ratio, that is X, Y and Z. Okay, so here is 10:6:2. This is our old ratio. Fine. Then A is a person who newly admitted to the partnership, so he share 1/10 of the share. Okay, so here you can see the A share is if the A share is 1/10, so what about the X, Y, Z share? So it is, I can say, 9/10. How do I calculate it? From the 1, if having the share of 1, so from the 1/10 is comes in the accounts of the A's account. Okay, so remaining 9/10 is comes in the account of XYZ. Okay, X and Y and Z's partner. Okay, so this is we have, that is, so 9/10 we have. So look over here, when we calculate the new ratio, okay, so what we need old ratio. Okay, and we have to multiply with this combined ratio. You can say combined ratio. So okay, so let's calculate X, Y, Z's. Okay, so here X ratio is 10/18. Okay, 10 plus 6 plus 2, 18, and 10 by X ratio is 10, so that's why it's 10/18. Multiply with combined ratio, that is 9/10. Okay, then exactly we do with Y, 6/18 multiply with 9/10, and again 2/18, then multiply with 9/10. Okay, why we take 9/10? Because 9/10 is a combined ratio, combined remaining ratio of the old partners. Okay, so we have to solve it. So when we solve this one, okay, 9 2s 9 2s 9 2s. Okay, so when we solve it, we will get in the first, that is 1/2. Okay, when we solve it, this is 5. Okay, so this is 1/2. Okay, this is 3, so this is 3/10. Okay, and this is so this one is 1 by no 1 18 2. Okay, Z is 18, 2/18. 1/2, 3/10, and this one, just give me a second, get confused. Okay, so this is the ratio that we have for, yes, 2 by this 2 1 and the 18 and 9/10, so into the, yes, 1/10. Okay, so 1/10 we have. Okay, so and also along with that, A is a share new partner, that is new partners A share ratio is 1/10. Okay, so here this 1/10. 5:3:2. Okay, so we have to correct this numerator. So here we have just first one, that is X X partners, we have to multiply with 5. Okay, so that's why this is 5 by 10, this is 3 by 10, this is 1 by 10, and this is also 1 by 10. So the profit sharing ratio is option number C, that is 5 by 3 by 1 by 1 is to 5 is to 3 is to 1 is to 1. Okay, so new profit ratio is option number C. Clear? Okay. Okay, anyone have doubt? Okay, the next question which is in your screen, the shares issued to existing shareholder when reserve are capitalized are right issue, bonus shares, preference share, and all of the above. The question is share issued to existing shareholder, okay, existing shareholder, okay, when reserve are capitalized, when we capitalized a reserve, so which share company issued to the existing shareholder? Isn't called as right issue, isn't called as bonus share, isn't called as preference share, or all of the above? So you know that this is simple question. When company have a reserve, okay, and he want to capitalize his reserve, but to capitalize his reserve, he issue the share to whom? To only the existing shareholder as a bonus share. Okay, so the bonus share is issued by the company to the existing shareholder out of the profit, or you can say from the available reserve and the surplus. Okay, so the option number B is correct. According to which of next question, that is according to which of the following accounting principle the owner of the businesses as considered as a creditor? The businesses as considered as a creditor: money measurement, cost, dual aspect, separate entity. Owner of the business, okay, as considered as a creditor. Consider as a creditor. Money measurement concept, that means is include only the transaction which is related to your money, so this is not an option. Cost is not an option. Okay, so the dual aspect, that means every entry having their dual entry, that means there is a debit and there is a credit. Okay, so this is also not an option. So the separate MTD concept is talking about, that is owner is a different and the company and the firm is a different. That means the owner of the company, if they as a consider owner of the company as a creditor of the company. Okay, so that's why option number D is correct. Next one, under how many headline the cash flow statement show the flow of the cash and the cash equivalent? How many headlines of in the cash flow statement show the flow of the cash and the cash equivalent? How many headlines in the cash flow statement? How many headlines in the cash flow statement? When we prepare the cash flow statement, when we prepare cash flow statement, in the cash flow statement we having the headline of operating activity. Okay, then also we have the headline of financial activity. Getting it? Activity. Okay, they also we having the investment activity. Okay, so we have three activities, we have a three heads when we are preparing the cash flow statement, that is operating activity, financial activity, and investment activity. Okay, so the option number C is correct. Okay, so 3 is right. Then the next question which is in your screen, which of the following is not a leverage ratio? Which of the following is not a leverage ratio? Total debt ratio, debt equity ratio, interest coverage ratio, and the quick ratio. Leverage ratio, that means it is related to your solvency ratio. Okay, and leverage ratio is about talking about the solvency ratio. What is the solvency ratio? Solvency ratio is one of the ratio is used to measure the what ability of company or the firm to meet the what their long term debts. Okay, so that is total debts. Total debt ratio is also talking about the long term debts. Debt equity ratio is also talking about the long term debts. Interest coverage, to whom we company pay the interest, to the debtors, to the debenture holder. Okay, so this is also your solvency ratio. But when we are talking about the quick ratio, it is not your solvency ratio. Okay, so the quick ratio, you can say this is for your short term solvency. This is for your short term solvency, and these all are related to your long term. Okay, long term solvency. So that's why a quick ratio is, it is your it is not a leverage ratio. Okay, then which of, next question which is in your screen, which of the following pair is not correctly matched? Installation of machine, installation of cost account, relevant cost, decision making, valuation of share, purchase of the company, and break even analysis, margin of safety is not correctly matched. So you can easily mark, that is option number D is correct, that is break even point. On the basis of break even point we calculate a margin of safety. Isn't it true? Valuation of share, the valuation of share, we do the valuation of share at the time of the purchase of the company, or at the time of amalgamation of the company, or the absorption of the company. Okay, this is also true. When we are talking about the relevant account, it is we prepare the relevant cost it for making the proper decision. Okay, and when talking about an installation of machinery, installation cost accounting we prepare. No, we actually, installation of machinery, it's not a separate part of the installation. Actually we take the entry of the installation in the account of machine account. Okay, so that's why option number A is not correctly matched. So option number A is correct. So thank you so much. We have completed over here 15 question. Okay, we will continue in next tomorrow. Tomorrow we will take a class. Okay, without fail. So see you in the next class.